Practical accounting, the better way to learn.
We're now going to take a look at another unique feature of practical accounting, the base method of inventory. This really works, folks. We've been using this for years. Okay. We can do the debit and credit thing, but look at it this way. Base, it stands for what you begin with plus what you add minus what you subtract equals what you end with. So when we're talking about inventory for a merchandiser, a store, if they start with $10, which would be a debit, and buy $20 more, that's called purchases, and have a cost. Now, remember, this is cost, not the revenue price. Cost of 25, we end with $5 worth of inventory. However, sometimes accounting reports do it a different way. This is actually how you do it with periodic inventory. So be aware of this. What we do is rearrange the equation and we say beginning plus purchases minus ending equals cost of goods sold. So using the base method is your friend to understand the flow of costs, and then you can go back to the debits and credits. So now let's apply this to manufacturing, and what we have here on this one page. We'll scroll down so we can have it all on one page. Whoop. Here we go, guys. Okay. For a manufacturer, we have three types of inventory. Our raw materials, remember, it's stuff we buy, what we begin with plus what we buy minus what we subtract. These are called raw material requisitions. Requisitions is a request from the factory for $25 worth of cheese and boxes and et cetera, means that we will have 5 left, just like before. However, instead of this going to the customer, we're now going to transfer it to direct material, and it becomes direct materials inside the factory. These direct materials are, this is a simple transaction between raw materials inventory and direct materials inventory, because now it is work in process. It is work in process. Total assets do not change. We're just changing from one category to another. Then we add direct labor. Then we add factory or manufacturing overhead. This is now we have made $65 worth of frozen pizzas. We started with $15 of work in process, partially completed pizzas. We spent $65 more producing pizzas. And now we have our second subtraction, our cost of goods manufactured. Cost of goods manufactured is exactly what it sounds like it is. It's the cost of what we made in the current period and transferred again to another category of inventory, finished goods. So if we have started with $25 worth of frozen pizzas, we transferred $70 worth of frozen pizzas out. Now we're going to sell them. This is our cost of goods sold. We'll end up with $35 a pizza. Notice this is the difference between cost of goods manufactured on this line and cost of goods sold on this line. So you probably won't be looking at the base method, but this is a handy way to work it and figure it out. So when you produce your schedule of cost of goods manufactured, you can pull it from this and understand what's going on. It's beginning work in process, the cost of goods manufactured, beginning work in process, plus beginning inventory, plus purchases, minus ending inventory equals raw material requisitions, which is our direct materials, add direct labor, add factory overhead, and solve for cost of goods manufactured. You might want to pause and just look at this for a little bit. Our income statement takes our sales revenue of $100 in our example, plus beginning finished goods, plus cost of goods manufactured, which comes from here, minus ending equals our cost of goods sold, minus selling and administrative expenses. These are our period expenses equals operating income. That concludes our overview, our cost accounting for now, but we'll be diving into it in job order costing, process costing, and activity-based costing in the next 3 modules.
You can get this Excel workbook and a whole lot more stuff for free at practicalaccounting.com. See you there.